This animated scale compares the two main engines of global finance. On one side is the global stock market. On the other side, towering over it, is the $120.58 trillion global bond market. Despite being the actual machinery that runs the global economy, bonds remain a blind spot for most people. Nearly 3/4 of American adults cannot answer basic questions about how they work. In fiscal 2024, the U.S. spent $879.9 billion solely on bond interest, eclipsing the entire U.S. defense budget and Medicare. Every dollar flowing into that massive bar is siphoned away from roads, schools, and hospitals. This maintenance comes straight from the public purse. When this market shifts, the damage is rapid. In 2023, Silicon Valley Bank crumbled in just 48 hours because of a bond portfolio. A year earlier, British pension funds nearly collapsed in days for the same reason. These sudden institutional failures are the direct mathematical results of the invisible bond market shifting. To see how a bond actually functions, look at this simple transaction loop. Imagine your friend needs to buy a $10 lunchbox. You lend them $10 today. That's the principal. They promise to pay you back in exactly 1 year. That's the maturity date. To thank you for your help, they give you an extra $1. That's the interest, or coupon. While buying a stock gives you a slice of ownership in a business, buying a bond makes you the lender. You are acting as the bank. The largest borrower in this ecosystem is the federal government. To fund national operations, they issue treasury bonds. You lend them cash, and they guarantee to pay you back. Companies like Apple and Amazon use the same mechanism. Instead of taking out a loan from a single bank, they issue corporate bonds to borrow directly from thousands of individual investors, usually paying higher interest to compensate for the risk. Local governments use them too. If a city needs to build a new highway or a water treatment plant, they issue municipal bonds. To attract investors, they often offer the perk of tax-free interest. Anytime a massive entity, a corporation, a city, or an entire country needs billions in funding, they create a bond to borrow it straight from the public. This mechanism illustrates the single most important rule of bond mechanics. It operates exactly like a seesaw. When interest rates are pushed up, the price of existing bonds is forced down. Consider a concert ticket. If you paid $100 for a ticket that pays you $5 a year, that ticket loses its resale value the moment the promoter starts selling new tickets that pay out $10. In 2022, the Federal Reserve aggressively raised interest rates to fight inflation. Older, lower-paying bonds suddenly became less attractive, and their value plummeted. Silicon Valley Bank was holding a massive portfolio of those older, long-term bonds right as interest rates skyrocketed. When they were forced to sell those bonds at a loss to cover customer withdrawals, the bank collapsed in under 48 hours. On the open market, even the safest bond is at the mercy of interest rate volatility. The center of American finance sits right here. The monetary policy set inside the Federal Reserve directly drives the 10-year Treasury yield. That yield acts as the benchmark for your daily life. When bond yields spike, the interest rates you pay for a mortgage or a car loan rise right alongside them. Bonds also serve as an economic weather forecast. Normally, long-term bonds pay more than short-term ones. But when that relationship flips, a dynamic called an inverted yield curve, it serves as a highly accurate early warning signal for a recession. You likely have more exposure to this than you realize. If you have a 401k or a target date retirement fund, you likely own massive allocations of bonds designed to balance out your stocks. Log into your retirement account today and check your fund's specific stock-to-bond ratio. You need to know exactly how much of your savings is sitting on that seesaw. You can also choose to act as the bank yourself. By purchasing high-yield I-bonds or short-term treasury bills directly from the government, you secure a predictable return backed by the full faith and credit of the United States. Understanding the bond market provides a direct lens into the movement of mortgage rates and the stability of global banks. This knowledge transforms a spectator into a strategic participant in a $120 trillion machine.